So, welcome to a new episode of the Boopos Buzz. Today we have Jeff Weinstein from agile Labs, and I'll let you introduce yourself, Jeff. I think it makes sense that you let us know what you're up to.
Sure. Thanks, Juan Ignacio. It's great to be here. My name, as you mentioned, is Jeff Weinstein. I'm one of the partners at FJ Labs. We're an early stage venture firm headquartered in New York with a global focus, and we invest in online marketplaces and network effects businesses globally. I've been at the firm for 7.5 years. I co head the investment team, and then I also work out on the fundraising side as well. Prior to this, I was at another venture firm in New York called Lux Capital for 4 years. And before that, I worked in finance at a fund of hedge funds.
Cool. Yeah, for full disclosure, FJ Labs is an investor at Boopos, so that everybody knows that. And the reason why, Jeff, I asked you to join us today is because FJ Labs, is invested in a number of rollups. You're a VC, and we work with a lot of rollup customers, people who are buying more than one target in some industry, and we would like to make sure that they understand that they have options for raising equity. We help them with the debt financing, and I think everybody's familiar with that once they speak with us. But the equity is probably the hardest part. So first of all, if you want, perhaps you can give us some thoughts on why you specifically think that investing in rollups is something interesting, and what actually has what are you looking in a rollup company so that it's good versus others that perhaps are not that exciting for you, or not interesting as you for you as an investor.
Sure. So, to be honest, our investment experience with roll-ups has been quite a mixed one. One of our best investments we've made in the past couple of years has been a roll-up. Uh, and yet, on the other hand, a number of our worst investments have been roll-ups as well. And so I think it's important to distinguish, instead of using roll-ups as an all-encompassing term, to basically discuss the various models that we've seen, where we've had success and where we've had failure. Because I actually think that as a whole, VCs have soured on the approach a little bit. And we can talk about why that is as well. So when I look at a roll-up business, the first thing I want to understand, and I think one of the most important concepts in venture, is that of adverse selection. So I think about this not only as a venture investor, but also when I'm investing in a startup, their underlying risk for adverse selection. So when I'm looking at a startup, the first thing I want to understand is, why am I seeing this deal? Why has this deal come to me? Now, for us, we've spent many years and a lot of effort branding ourselves as marketplace investors. And so we try to counter our adverse selection through reputation. When you, as a roll-up founder, or when you're looking to make acquisitions, I think the most important guiding principle is making sure that you're solving for adverse selection as well. So many of the roll-up businesses that we've invested in, the first question we'd ask is, why are you seeing a deal? Why are you earning the right to win a deal? And how do you make sure that you're solving for adverse selection? And frankly, a lot of the roll-ups that were raising money in the past couple of years mistakenly thought they had solved for adverse selection, but in fact, they were buying subpar businesses. They were either overpaying on price, or they were only buying from founders frankly, they were on the losing end of a transaction. And so the guiding principle for us as we think about roll-ups is, what is a roll-up at the end of the day? So you're in a market, someone's selling to you, they're on the other side of the transaction, and you have to understand, why now and why me?
Yeah, that makes sense. One question that I also have for you related to this is, how do you see technology playing in these type of strategies? I guess that you guys are ABC, you have a lot of non-roll-up investments as well in the technology space, and I've seen two types of strategies. One of them is, let's buy several software businesses together and figure out what the synergies are within one specific platform. And then I've also seen people buying traditional businesses and adding a technology layer to make it succeed. What do you think about that? Do you think these are winning strategies, or it will, I guess, depend on how they're executed, right?
I think the answer is it depends. A lot of the roll-up investments that we've seen, and many of which we've made in the past years, claim to have some sort of uh, technology layer, which creates either synergies or margin expansion. And so, one example, we did a number of the Amazon aggregator startups, and so the argument there was uh, you can create economies of scale and you can create other synergies by having a unified back office, unified logistics, distribution, inventory management. Frankly, that didn't really happen. And what instead happened is basically a lot of these businesses got overextended, they overpaid, they got over levered, and so generally what I found so far is that frankly the claimed synergies do not outweigh any indiscipline when it comes to price. And so th- the roll up investment that we've made that has been most successful so far, frankly, doesn't even necessarily claim to have that much in the way of synergies, but they've just been extremely disciplined with their buy bucket, and they do as much as they can to make sure they're not just getting into auction processes, and they remain extremely disciplined when it comes to making transactions. And so am I seeing now there's an interesting new thing where obviously now we have this AI transformation, this revolution where people are arguing that actually now you can create even more margin expansion by layering in AI. And so you can, whether it comes to customer service or back office, you can even do more in the way of synergies. That may be true, and I'm seeing a new wave of startups raising money off this idea, which is that they will basically buy legacy businesses, they will gut them, and they will transform them, and they'll be AI native businesses. I have yet to see that succeed. That doesn't mean it won't. I actually think it's quite interesting. But another question that I always ask, frankly, when I'm viewing this as an equity investor is I mean, what you guys are describing is basically just private equity. Why am I, as a venture investor, using expensive venture capital to go try to basically compete with private equity? Now, private equity, like roll ups, are a very well established thing, but I'm talking like my cost of capital is quite high as a venture investor. And so, is this just basically a bunch of tech bros who think they're reinventing private equity, or is there actually some sort of tech angle here which is going to compensate for what ostensibly should be mid 20s IRR capital, right? I think that this is why I wonder if the whole concept of roll ups should be venture capital at all. And I think that is, frankly, as of now, I think it should not be. I think that roll ups are a PE game, and I think a lot of VCs got diluted due to low interest rates into thinking that they could be a VC game.
That's true. That's very interesting, actually, because I think sometimes technology rollups sit in between VCs and PEs, and I'll tell you as a fundraiser in the past, I've talked to PE companies, and they said this is too techy for us. Then I speak to VCs, and then they say this is a PE game. So it's kind of hard to find investors that are in the intersection and that can understand both worlds. But yes, I guess I agree that if it's just a financial play, then why would you raise expensive VC money instead of just going the PE route, right? I guess that one of the
Absolutely.
things that in the end founders are trying to do is optimize for valuation, and generally VCs offer high valuations, and that's the thinking. But high valuations obviously come with a high expectation, so you have to meet those expectations.
And
Um,
I think, frankly, by the way, as interest rates have gone up, I think VCs have learned the painful lesson that these aren't really tech companies. And so, if you fundamentally, what is a roll up? What you're doing is you're borrowing or you're raising money, whether it's via equity or debt, and you're using it to go purchase an asset, and you're trying to grow that asset either organically or inorganically. And I don't necessarily believe, actually, frankly, I don't believe that this is what venture capital is designed for. And so, frankly, we've made a lot of mistakes in the past. Now, I will say that there are instances where you may have a distribution advantage. So, for example, the best deal that we've done in rollups, and it's funny, given the power law nature of venture, this one deal more than compensated for all the other failures. So I would say our median rollup investment has been a bad one, but because of the power law distribution, our mean investment has actually been a good one because of this one deal, basically. And this one deal, what they were doing is they're basically a managed repair network for roofing in the US. So imagine in middle America, you have a house, it got destroyed by a hailstorm, the roof. And you need to go, and you're covered by home insurance. And so the insurance company needs to find labor to go fix the roof. How do they do so? Enter this company. And the company is now called AccuServe. And what they do is they basically partner with Liberty Mutual Insurance or other insurance companies to have this vetted repair network to go fix houses that are destroyed by storms. This is a really interesting application for a roll-up play because you have this distribution with the insurance companies. And so you offer them roofing services, but you can offer windows, you can offer driveways, whatever. So what they do is, because they already have this built-in distribution, they can go and they can buy a local uh, window company to basically add another service that they can sell to insurance. So that's a really interesting application for a roll up. And frankly, that's worked extremely well. But that is not the typical roll up investment that VCs are making. Like what I was seeing is a lot of Amazon roll ups, a lot of Shopify roll ups. I've seen a couple of Salesforce apps roll ups. And I've seen various roll ups where you basically see an interesting ecosystem and you can basically bolt on synergies. But that is just by the way, the other thing I'll say is that AccuServe deal, that was actually a private equity deal. My buddy who brought me into that deal was a PE investor, and I knew going in eyes wide open that this is likely to be a PE style return profile. It just so happened that we lucked out and it actually got us a venture outcome. But nonetheless, that this my firm belief is that largely roll-ups are a PE game versus a VC game.
Mhm. Agreed. Still, the home service business and the home service industry is very attractive. I mean, I used to own, when I was at a PE firm, not personally, obviously, a similar business in Spain, and it was one of the most successful investments that we had as a firm. Because again, as you mentioned, there's an opportunity. There's also an opportunity to work. In the end, the people who are doing the repairs can be external to your company. So in the end, you help them build a platform in which they can manage their time, and in a way, you end up becoming more of a technology company and I would say a marketplace for these people to offer the services to insurance companies
Yes,
rather than a home repair business. So
that's
that's
totally.
a good one. Yeah. By the way, other than that, are you seeing? You mentioned Salesforce, Salesforce apps. We've seen also Microsoft apps. Are you seeing? Are you seeing at the moment any interesting verticals, any interesting industries or hot spaces to be in the roll-up world?
I'm still seeing some firms raise money trying to do HVAC. I've seen a number of those. I've seen actually a founder we previously backed is rolling up pool services companies, which I think is interesting. Again, the general, like the unifying theme I'm going to say here is why is this not just tech bros trying to reinvent private equity? So like I am inherently skeptical of this using venture capital. That doesn't mean it doesn't work from private equity, but it's just different return profile, different cost of capital. So let me emphasize again that as a VC, I have a lot of inherent skepticism here. Uh, and so my bar has been raised quite highly. And so I like when I get an inbound roll up pitch, I come in quite skeptical. And so I've seen a number of trying to basically do software roll ups. A mutual friend of ours, who I will not name, let's say, is doing iPhone app roll ups, and he's doing so quite successfully. And so again, I want to caveat this by saying, like, I have made a number of investments in the space. Some of them are doing quite well, but again, it's like a median investment versus a mean investment situation.
Yeah, but the fact that you're skeptical but still look into the pitches sets you apart from other VCs, because some other VCs will just bounce it straight away and say roll-ups are not for us.
It is tempting to do that, and I have to actually fight against that instinct where I roll my eyes. I say, "Oh my God, not another roll up." But I will look, and I will be open minded because, frankly, the way I think that you make money in venture is not just being, you have to be right, but you have to be non-consensus right. Because if you're making a consensus investment, the entry valuation reflects that. And so now may actually be an interesting time to be looking at these roll-up deals because VCs have soured on them so much that the entry valuations will reflect that. So the Amazon aggregators were the hottest thing in the world in 2021. Everyone was buying secondary and Thrasio and trying to bid up these assets. But now it's so unpopular among VCs that it's an interesting time for me to actually be looking, even though I'm very, very skeptical.
Mhm. Yeah, makes sense. Let's talk a little bit about operations. I've seen again different strategies. People setting up a kind of dream team at the beginning, and being aggressive in acquiring big targets, and being bold about setting up a big company. And then I have seen other people setting a small kind of hustler type of team. What do you think about that? In the end, I guess that your overheads can eat all the profit away and make you raise equity for just funding OPEX, which is something that VCs are used to in the end, because that also fuels growth. But then if you're acquiring assets, then that's probably not likely to fuel growth. That's what I'm thinking. But perhaps there's a reason why you want to have a strong operational team. I don't know. What have you seen there?
There are different approaches. I think the real question is, philosophically, do you believe in that you're taking a almost like an allocate like an asset allocation approach, like an investment mindset, like a financial mindset, or if like you're taking an operator first and an operations mindset. I've seen both. If you believe it's really just a game of almost like, if it's like a financial game, then what you really care about is it's all, I mean, this is very reductive, okay, but like in many ways you're thinking about entry valuation and like entry discipline, and then exit valuation and exit discipline, and you can do that and be operational and hands on, or you can do that and be hands off, and then you're really just betting on the horse that you're backing, right? So I've seen centralized models where they basically build a centralized platform, very operational intensive superstar team like what you've described. Many of the Amazon aggregators in the early days were playing off that, and you would see a lot of people who were actually ex Amazon, like, oh, I ran Amazon's e-commerce in Latin America, or I ran Amazon's e-commerce in the UK, and they would try to raise off of that, uh, and then they would basically buy the assets and bolt them onto this centralized platform. And then occasionally you see, no, like, here's the team. Let's just build a bunch of seller financing in and make sure we keep the team well incented. More of like a Berkshire approach, right? Think about Berkshire. How big, like, Berkshire HQ is tiny, and they basically are just buying really, really well run assets, and they're letting the team stay there. And so I think they're both. You just have to really know what your DNA is and what your approach is.
Mhm. Agreed. Do you know, by the way, this is the time of SaaS rollups. I've seen a lot of people that run e-commerce rollups 3, 4 years ago, flocking into the SaaS rollup space. And I'm wondering first of all, I mean, it's fine, people can reinvent themselves, but what's their advantage given that you have people or companies like Constellation Software acquiring SaaS businesses since 30 years ago? And I don't know. I feel that space might become a little bit crowded, but perhaps you haven't seen that.
You're preaching to the choir, man. This is exactly what I ask people. It's like, okay, you've reinvented Constellation software. Like, really? Why do you think you're good? And by the way, the other thing I will always ask is like, it what why do you win? It's like going back to the very first thing I said, adverse selection. Why are you winning the deal unless you're just overpaying? because like I'm a big efficient markets guy, right? And like you can't assume that you're pulling a fast one on the seller. Assume the seller's sophisticated. Now look, maybe there's a world where actually you're fishing in an area that is truly uh, non-competitive, and you're the only bidder. But then also you should wonder, like, why am I the only bidder? What's going on here? Is it what am I like? You have to like believe that your seller is a sophisticated one, and that they are going to shop this around, and that they're going to get the best price possible. And so you have to go in eyes wide open and understand that if you're paying this price, this is how you're going to earn it, and that you have to just be on guard when you're buying these assets. And so that's why the best operator who we backed in the space, who is our mutual friend, uh, is unbelievably thoughtful about entry price and price discipline and valuation. And so uh, his North Star is basically being wary of uh, adverse selection. And by the way, you can also look. My favorite quote is Charlie Munger: "You show me the incentive, I'll show you the outcome." That's why I like not only seller financing, but like when the seller rolls a big piece of their equity into the transaction. I don't really like seeing a lot of these cash transactions because then you're really getting dumped on, you know?
Mhm. Yeah, I agree. And I think one interesting thing about this common friend is that he's also running in our Rollup in a platform which is iPhone apps, which is perhaps out of Constellation Software's scope. I think it's perhaps less crowded in terms of acquirers
Yes,
or buyers. So perhaps he being one of the first and understanding the value in that platform also adds
absolutely.
value. I know.
Absolutely. Absolutely.
Okay, I mean we're getting closer to the end of the interview, and I would like to hear. I don't know. Perhaps you have closing remarks. Essentially, ideally, any tips that you can give to people who are starting their roll-ups, who are starting to think of putting companies together, or perhaps that are already in the path and are ready to raise equity from investors. What do you think they should have before getting or going down that route?
I think the my closing message would be you have to think extremely carefully about how you capitalize the business. The thing that has been killing all of these startups is in the space, and frankly a lot of our portfolio companies, what did them in was debt. And so obviously they were raising capital in a very different environment where interest rates were zero, near zero, and they all got over levered, and they got just absolutely slaughtered when interest rates came up. And so I think debt is taking out startups left and right now. A lot of startups got over levered. Uh, and look, we're in a different environment now where debt is expensive and it's harder to come by. And so if that's the case, then you have to wonder, like, just thinking about sustainable business building here. Uh, does it make sense to take venture capital? Right? Like VCs are underwriting 20% plus IRR on their investment. And by the way, PE is the same. It's just different hold periods, right? Like a PE fund is looking to earn mid-teens plus. So how do you finance this business? Does it make sense because once you get on the venture treadmill, you can't really get off. It's very, very rare to see a venture-backed business raise once or twice and then never raise again. And so it's almost like a Faustian bargain here, where yes, you're getting venture capital at a higher valuation, but what is the expectation? Like one thing I always push founders on is, okay, and then what? Suppose you're raising a $3 million seed round. Where does that take you? What runway does that get you? At that point, how big is the business? How much cash are you burning? What scale are you? What round do you justify at that point? And so it really is almost like a treadmill. You're going from point to point to point, and you have to make sure that you're default investable that entire time, because if not, game over. And by the way, a lot of people, you raise equity to raise debt. Okay, so imagine you raise 3 million of equity and then you raise 5 million of debt. And then okay, so then next round you're going to raise 10 million of equity and you'll raise another 10 to 20 million of debt on top. Well, imagine things don't go to perfection. Imagine you have an acquisition that takes longer to mature, or for some, it ends up that you, sure enough, that adverse selection got you and things don't execute to perfection. Well, now you have a ton of debt and you either have to go refinance or you have to pay it back. What then? So I guess my general point of caution is think very, very carefully about how you capitalize the business, whether it's via equity, whether it's via debt, whether it's VC or private equity, and just try to build in some margin of safety, because it's sad we're seeing a lot of these roll ups getting crushed right now.
Yeah, no, that's a very sound advice. I think that in general, if you're raising VC money and you're leveraging that with venture debt, which will eat like 15% cash plus the warrants, then that means that you have to go at least 2x year over year, but ideally 3x. Otherwise, you're going to be left out of the game.
Yeah,
Um,
that's it,
I
and that's
think.
right. And think about how is that feasible? I mean, think about when your roll ups imply inorganic growth, and how quickly can you grow these properties organically? It really has to be something quite special.
Agreed. All right. Well, that's a very interesting closing thought. Jeff, it was great to have you here today. I think you gave very useful advice to our community. And yeah, thank you.
No problem. Thank you.